Listen up, folks. You want to make money in the stock market? Then you got to know how to analyze stocks. It's that simple. Stock analysis is your secret weapon. It's how you separate the winners from the losers. Without it, you're just throwing darts at a board blindfolded. And let me tell you, that's no way to invest your hard-earned cash. Now, I know what you're thinking. Kramer, this sounds complicated. But trust me, it's not rocket science. Anyone can learn to analyze stocks. You just need the right tools and a little guidance. That's why I'm here. I'm gonna break it down for you in simple terms. No fancy jargon, no confusing charts. Just straight talk about how to pick winning stocks. Are you ready? Let's dive in. All right, listen up. We're diving into the nitty-gritty now. Financial statements. They're the backbone of stock analysis. Think of them as a report card for companies. There are three main types you need to know: the balance sheet, income statement, and cash flow statement. Let's break them down. First up, the balance sheet. It's like a snapshot of a company's financial health at a specific moment. On one side, you've got assets. That's what the company owns. On the other, liabilities. What it owes. The difference? That's shareholder equity. A healthy company should have more assets than liabilities. Next, we've got the income statement. It shows how much money a company's making or losing over time. Revenue at the top, expenses subtracted, and what's left at the bottom. That's profit or loss. Last but not least, the cash flow statement. It shows you how cash is moving in and out of the business. Profit isn't the same as cash. A company can be profitable on paper, but still run out of cash. The cash flow statement helps you spot these potential problems. Pay close attention to operating cash flow. That's the lifeblood of any business. All right, folks, now we're cooking. We've got our financial statements, but how do we make sense of all those numbers? That's where key performance indicators, or KPIs, come in. These are the vital signs of a company. They tell you if a business is healthy and growing, or if it's on life support. First up, revenue growth. You want to see a company's revenue growing year over year. Look at the trend over several years. Is growth consistent? Is it accelerating or slowing down? Next, let's talk about profit margins. Revenue's great, but it doesn't mean much if a company can't turn it into profit. Gross margin shows profit after subtracting the cost of goods sold. Operating margin factors and other expenses like salaries and rent. And net margin? That's the bottom line, how much profit is left after all expenses are paid. Higher margins are generally better, but remember to compare within industries. Now let's talk about return on equity, or ROE. This measures how efficiently a company uses its shareholders' money to generate profit. A higher ROE is generally better, but again, compare within industries. Lastly, don't forget about debt. A company's debt-to-equity ratio tells you how much it's borrowing compared to what shareholders have invested. Some debt can be good. It can help a company grow faster. But too much debt? That's a recipe for disaster. Look for companies with manageable debt levels. Listen up, folks. We've talked about individual companies, but now it's time to zoom out. You can't analyze stocks in a vacuum. You need to understand the big picture, the industry trends. Because let me tell you, even the best company in a dying industry is going to struggle. First things first, you need to identify the industry. Sounds simple, right? But it's not always clear-cut. Take Amazon. Is it retail, tech, cloud computing? The answer is all of the above. And that's important to know because each of these industries has different dynamics. Once you've identified the industry, it's time to look at growth trends. Is the industry expanding or contracting? What's driving that growth or decline? For example, look at the electric vehicle industry. It's growing like crazy, driven by concerns about climate change and advances in battery technology. Next, pay attention to disruptive forces. These are game changers that can upend an entire industry. Think about what Netflix did to video rental stores, or what Amazon did to traditional retail. Lastly, don't forget about regulatory trends. Government regulations can have a huge impact on industries. Just look at the tobacco industry. Increasing regulations have made it a tough business in many countries. Always keep an eye on how regulations might affect an industry's future prospects. It could be the difference between a winning investment and a losing one. Section 5. Digging Deep, Fundamental Analysis Explained. All right, folks, Now we're getting to the meat and potatoes of stock analysis, fundamental analysis. This is where we roll up our sleeves and really dig into a company's value. It's not about what the market thinks a company is worth. It's about what it's really worth, based on its fundamentals. Let's start with the basics. Fundamental analysis is all about intrinsic value. That's the true value of a company, based on its financial health, competitive position, and future prospects. The idea is simple. If a stock is trading below its intrinsic value, it's undervalued. If it's trading above, it's overvalued. Your job as an investor is to find those undervalued gems. So, how do we calculate intrinsic value? One common method is discounted cash flow, or DCF analysis. You project a company's future cash flows, then discount them back to present value. The sum of those discounted cash flows? That's your estimate of intrinsic value. But fundamental analysis isn't just about crunching numbers. It's also about understanding a company's competitive position. This is where Warren Buffett's concept of an economic moat comes in. An economic moat is a sustainable competitive advantage that protects a company from competitors. Fundamental analysis also involves looking at the quality of management. Because at the end of the day, you're not just investing in a business, you're investing in the people running that business. Section 6, Chart Magic Technical Analysis Basics. All right, folks, now we're switching gears. We've talked about fundamental analysis, but there's another school of thought, technical analysis. This is where we look at stock price patterns and trading volumes. Some of you might be skeptical, but hear me out. Technical analysis is based on a simple premise. Stock prices move in trends. Technicians believe all relevant information is reflected in a stock's price. By studying price movements, you can predict future behavior. It's about identifying probabilities and trends. Let's start with price charts. The most common is the candlestick chart. Each candle represents a period of time. The body shows the opening and closing prices. The wicks show the high and low prices. Green candles mean the price went up. Red means it went down. These charts can reveal patterns indicating future movements. Section 7. Building your portfolio. Smart strategies for beginners. Listen up, folks. We've covered a lot of ground, but now it's time to put it all together. How do you actually build a stock portfolio? I'm going to give you some strategies to get started. Remember, investing is a marathon, not a sprint. First things first, diversification. Don't put all your eggs in one basket. Spread your investments across different sectors. Different sectors perform differently under various conditions. This helps smooth out your returns and reduce risk. Start with at least 10 to 15 different stocks. Now let's talk about position sizing. You don't want any single stock to make or break your portfolio. A common approach is to start with equal position sizes. Next, up dollar cost averaging. Invest a fixed amount regularly over time. Section 8. Tools of the Trade Essential Resources for Stock Analysis. All right, folks, let's talk tools. In today's digital age, you've got a wealth of resources at your fingertips. And let me tell you, using the right tools can make your stock analysis a whole lot easier and more effective. So listen up, because I'm about to share some of my favorite resources for stock analysis. First up, financial websites. Sites like Yahoo Finance, Google Finance, and CNBC.com are great starting points. They provide real-time stock quotes, financial statements, news, and basic analysis tools. And the best part? They're free. These sites are like one-stop shops for basic stock information. But remember, they're just starting points. Don't rely on them exclusively for your analysis. Next, let's talk about stock screeners. These are powerful tools that let you filter stocks based on specific criteria. Want to find all the tech stocks with a PE ratio under 20 and a dividend yield over 2%? A stock screener can do that in seconds. Some good ones include FinViz, which is free, and StockRover, which has both free and paid versions. Section 9. Common pitfalls. Mistakes to avoid when analyzing stocks. Listen up, folks. We've covered a lot of ground, but now it's time for some tough love. I'm going to tell you about some common mistakes that trip up many investors. Because let me tell you, in the stock market, knowing what not to do is just as important as knowing what to do. So pay attention, because avoiding these pitfalls could save you a lot of money and heartache. First up, falling in love with a stock. I see this all the time. An investor finds a company they like, and they become emotionally attached. They ignore red flags and keep holding even when the fundamentals deteriorate. Remember, folks, stocks don't have feelings. You shouldn't either. Always be ready to sell if the story changes.